by 50% in the new year. Joining us at Post 9, Fundstrat Global Advisors co-founder and head of research, Tom Lee. Welcome.
Happy New Year, everybody.
So everybody was negative this time last year, but you were not. Why?
Yes. Well, it's really two things. One, we thought inflation would fall like a rock, whereas many were bracing for a decade of sticky Fed fighting inflation. And the second was, if that was true, that we would avoid a hard landing, and soft landing was the most probable outcome. So that's pretty stock friendly, right? Inflation falls like a rock, you avoid a hard landing, and markets were down 20% the year before.
So in 2024, will inflation keep falling like a rock, and will we still have a soft landing?
Yeah, I think your food chart is spot on. I think consumers will realize that the rate of price increases is slowing. We saw it in the UMich surveys. That will give Fed a lot of leeway to cut rates next year to keep real rates constant. Housing and autos is really 70% of inflation, so both are going to normalize, and that means 2% is going to be very visible next year. And I think it's a huge relief for equity markets when that happens.
Tom, Happy New Year.
First
of all, congratulations on your calls this year. You've been directionally correct. That's hard to do, so kudos to you. You're top dog now, 5,200. You have the high estimate for the S&P 500 for 2024. Jonathan Stoltzfus, we just had him on, he also had 5,200. You're top one. I wonder if you can explain what goes into making that up. It's always a little bit of a mystery to us what you macro guys do. You know, an analyst who covers Caterpillar, he studies Caterpillar, earnings estimates and makes a projection, but you have to do this estimate from the top down. So what goes into this? Do you guys get together in a retreat on the weekends and drink a lot and figure out what's going to come up with a number? How do you come up with this 5,200?
Yeah, it's really sort of three parts. The first part is what is probable based on sort of market history, like where we are in the business cycle, what did the markets do the year before, where's positioning. That's more of gives you a pretty wide highway to think about what markets could do. So next year, double digits is more than a 50% probability, even though we were up 25% this year. But then we look at E, the earnings, and we think, can you grow 10%, which I think is easy base case because there's pent-up demand for CapEx, and we know the PMIs are going to turn. And the guidance actually has been pretty decent. And then it's what multiple do you apply? This is where I think people make mistakes. When the 10-year is at between 3 and 4%, 65% of the time the PE is over 18 times. 50% of the time it's over 20. That's since 1900. Well, the S&P equal weight is 15 times forward, or ex-FANG, it's 15 times forward. Well, if that 15 goes to 18 or 15 goes to 20, the stock market's going to be up 30%. So we figure, well, you hold the multiple, earnings grow 10, you get 5,200, but that means there's upside to that number.
A lot of assumptions built in there.
Yeah.
A lot of assumptions here. So you move the slider either way on a lot of these assumptions very easily. Your multiple is a little high, though, isn't it, at this point? I mean, I don't like to do ex-FANG and those kinds of things. Right now, the street's at almost 20 times forward earnings right now. I don't know what your multiple is at.
Yeah,
you're right. This is where people mess up.
Yeah.
What's a dollar of future earnings worth? That's the multiple.
Well, remember, investors can buy any stock. So if they buy the S&P, if they buy the index, then they're buying the FANG 40% weight at 30 times. But if someone's buying, like you said, JP Morgan at 11 times, or, they're buying 20 stocks in the S&P and they're paying 13 or 14 or 15 times, actually the 10-year tells you that could be 20 times.
But we're not. We're buying the S&P. You have a 5,200. That's what I'm trying to, you want to X out. You seem to want to move out things and X things out.
Well, actually the best way to do that is well, should the FANG multiple come down next year, right? So you do a sum of the parts. And why should the FANG's multiple decrease when they're going to grow earnings 25%? I mean, in a way, you'd actually argue the market has more upside if FANG holds its multiple because of the earnings growth they're going to have. So I think people trick themselves into think the market's expensive, but it's the same as someone saying, oh, because the S&P is expensive, Japan's expensive. It's not. You're buying equities, but you really want to think about each component you're paying for.
I want to talk about your small cap call, because that's a big one. 50% next year. We've certainly, if that happens, have had a preview in the last few weeks about the comeback in small cap. But why do you think there's so much room left to run here?
Well, I think people need to put a long-term lens on small caps. on a price-to-book basis for Russell, which is the highest correlation to forward returns, relative to S&P, it's at the 1999 lows. You've never seen them cheaper. 1999 was...
That's always the case for small caps, is that they're cheap.
It's the first time they've touched these levels in almost 40 years. So, but in 1999, that was the launch point for 12 years of gains. And if you look at the earners of the small caps, which is like the S&P 600, they're at 11 times forward earnings. So can the multiple expand in small caps if we have weaker dollar, PMIs turn up? Yeah, I'd say easily. Can the earnings go up a lot? Yes. And you know, small caps this year proved it. You know, we turned bullish on small caps around November, and people thought maybe it's just to base it up 5. It's up 25%. I think small caps could easily add 50 percentage points next year.
But can small caps rally when large caps are not rallying, when tech is not rallying?
There's a lot of precedent for that. Like 99 to 2003, you had a pretty vicious bear market. Those were some of the best absolute return years for small caps.
Small caps, long term, tend to outperform big caps. Value tends to outperform growth. It just doesn't happen in our recent memory that much. Wouldn't that be something if that happened?
Yes, and you know, many are skeptical small caps could work. Most think it's a tourist trade, like they want to maybe own it for a couple months. So the less likely outcome is they do well the entire year.
Right. And I know you expect a little turbulence in February, right, March?
Yeah, yes, I'd say if history was sort of your guide, January, February, S&P gets to 5,000. I mean, I think new highs is just a matter of days. But then the late Feb, March, April is when you get the 5-10% drawdown.
And then up from there.
Yeah, and then up from, but that's the big growth scare, and so everyone will panic, and that's probably the time to be buying again. So.
Well, no doubt we will be speaking to you many more times before then. Thank you very much,
Thank
Tom
you.
Lee.
Happy New Year, Tom.
Happy New Year. As we head to break, here's our roadmap for the rest